Good evening. Pull up a chair. The financial universe, much like a high-stakes poker game played across multiple time zones, has just wrapped another 24-hour session. And if you were looking for clarity today, you didn't find it. What we saw was the market holding its breath, a strange, almost flatline performance across the major indices, punctuated by underlying tremors. Take a look at the scoreboard. The S&P 500, SPY, is down a mere 0.12%, perched at 687.01. The tech-heavy Nasdaq Composite, QQQ, is marginally worse at minus 0.23%. This isn't a rout. It's indecision etched in the charts. Yet, look closer at the small caps, the engine room of domestic growth. The Russell 2000, IWM, took a more definitive haircut, shedding 0.74%. That divergence, the relative weakness in the smaller names versus the stability in the giants, tells you where the conviction, or lack thereof, is currently sitting. Meanwhile, Bitcoin and Ethereum are dancing to their own beat. BTC nudges up 0.07%, ETH follows at plus 0.05%. In a day where traditional risk assets were hesitant, digital assets, the poster children for speculative risk, are essentially flatlining, indifferent to the equity nervousness. This suggests that whatever is holding the traditional market back isn't causing a full-blown digital asset panic either. It's a vacuum of direction. When the market is listless, we turn to the noise, the personalities who drive narratives, to try and find the signal in the static. And today, the noise was deafening, a cacophony of political theater and financial celebrity cameos. On one side, we have the political heavyweight division. Former President Donald Trump is publicly laying into Fed Chair Jerome Powell, calling him a fool, and even threatening a lawsuit over HQ renovations. This is pure narrative aggression directed squarely at the central bank's independence. It adds a layer of political uncertainty to an already complex monetary environment. Speaking of central banks, Christine Lagarde over at the ECB has a minor victory brewing as Bulgaria gears up to adopt the euro, showing some peripheral faith in the bloc structure, even as Spanish inflation clocks in at 3%, backing the ECB's current hold stance. Then you have the titans of industry. Elon Musk remains an enigma, with reports poking into the mystery surrounding his Dogecoin activities. A reminder that even the world's richest individuals are still operating in shades of grey when it comes to digital assets. Conversely, the AI king, Jensen Huang of Nvidia, faces scrutiny. A Fortune piece highlights that the economics of AI chip building are still unsettled, evidenced by Nvidia's recent bet on Grok. This means the AI infrastructure build-out, the sector that has carried the market, might not be the smooth, guaranteed trajectory many assume. On the corporate side, the legends are shifting gears. Warren Buffett's absence following Berkshire Hathaway's transition marks the end of an era, while Cathie Wood of ARK is back in the spotlight, having crushed the market this year, a testament to the enduring, if volatile, power of growth bets. And in a bizarre cross-section of tech billionaire behavior, Mark Zuckerberg is facing backlash for extravagant displays while launching new healthcare ventures with Jeff Bezos. It's the billionaire class flexing their capital across every sector imaginable, from medicine to social media, while the main indexes wobble. If the equity market is bored, the bond market is definitely wide awake, and it's sending a very specific signal, one that traditional stock pickers often miss. Look at the 10-year Treasury yield, TNX. It ticked up 0.34% to 4.13%. That's a meaningful move. Higher yields mean bond prices are falling, and they are signaling that the market expects inflation to remain sticky, or that the economy is resilient enough to absorb higher borrowing costs. But here's the crucial connection. When yields rise, it directly impacts the valuation models of those high-flying tech stocks that are priced heavily on future earnings. Think the Mag 7 names. It also puts the squeeze on smaller companies, which is exactly what we saw in the IWM's underperformance. This rising yield environment also provides context for our volatility indicator. The VIX, the market's fear gauge, is up 0.92% to 14.33. That VIX isn't screaming panic, but it's certainly elevating itself above comfortable levels, suggesting ambient nervousness. The bond market is the quiet alarm bell, telling us the cost of money is reflecting a less optimistic inflation outlook, even as the S&P 500 barely budges. The global central banks are caught in the middle of this tug-of-war between sticky inflation and decelerating growth signals. In the US, the minutes from the last Fed meeting revealed a tight split over even considering a December rate cut. That hesitation from the Fed hawks is what's keeping the 10-year yield supported at 4.13%. They aren't ready to commit to easing, fearing that policy normalization is premature. Meanwhile, across the Atlantic, Lagarde's ECB is getting backing for their current holding pattern. Spanish inflation at 3% suggests inflation pressures are stubborn there too, meaning the global playbook remains wait and see. This divergence, US Fed officials split, ECB holding steady against persistent inflation, creates currency friction. The dollar index, DXY, NYB, is creeping up 0.08%, and the euro, dollar, or USD equals X, is slipping 0.29% to 1.17. A stronger dollar generally puts pressure on US multinational earnings, another headwind for the large cap names that dominate the major indexes. Adding to the domestic confusion, there's fresh, localized macro data. The signing of Representative Schuette's home heating credit plan in Michigan is a reminder that fiscal policy, in the form of targeted subsidies, is still active, potentially adding localized inflationary pressure that the Fed has to contend with. Simultaneously, the Chicago Fed is forecasting a December unemployment rate of 4.6%. If that holds, it suggests the labor market remains tight, which is great news for Main Street, but terrible news for the Fed's inflation mandate. Complicated is the word of the day. Commodities reflect where global demand and geopolitical stress points meet. Today, the picture is muted but still showing vulnerability. Crude oil, WTI, CL equals F, is practically unchanged at $57.92, suggesting that the fear of a supply shock is currently balanced by concerns over global economic appetite. The small dip, minus 0.05%, suggests a very slight softening in near-term demand expectations. More telling is gold, GC equals F. The safe haven metal is down 0.62% to $4,342.80. This is counterintuitive when the stock market is hesitant and yields are rising. Usually, rising yields hurt gold because it yields nothing. However, the fact that gold is dropping despite the VIX ticking up suggests investors are prioritizing yielding assets, like treasuries, even at current rates, over non-yielding hedges right now. The consensus among some icons, like Ray Dalio, who advocates for buying gold, is clearly not winning the day's trading action. Let's zoom in on the names driving the S&P today. The tech giants are showing cracks, but not breaking. NVDA is down 0.36%, a slight pause after its meteoric run. AAPL is off 0.25%. But the story is in the divergent flows. Microsoft, MSFT, is actually up 0.08%, and Amazon, AMZN, leads the mega caps up 0.20%. This suggests capital is rotating slightly within big tech, away from hardware, chip dependence toward cloud services and e-commerce resilience. The real pain point today was Tesla, TSLA, plunging 1.13%. This stock is an excellent gauge of speculative sentiment. When investors get nervous, TSLA is often the first thing sold. We even see investor Michael Burry publicly stating he is not shorting Tesla anymore, a small signal that perhaps the pressure on TSLA is nearing an inflection point, or at least that one of the biggest bears has stepped back from the cliff edge. In terms of industry news, analysts are getting constructive on travel. UBS is bullish on American Airlines, AAL, based on recovering corporate travel. This lines up with the slight strength seen in Amazon and Microsoft, suggesting that enterprise spending and business travel are holding up better than general consumer sentiment might imply. Furthermore, banks like BAC and PNC are seeing positive target adjustments after management meetings, suggesting institutional money is seeing stability in the financial system infrastructure. As noted, the digital assets are running on parallel tracks. BTC and ETH are virtually flat. This sideways consolidation, while the stock market is choppy, implies that crypto investors have either bought the recent dip or are waiting for clearer signals from the traditional side or major institutional figures. Speaking of figures, Michael Saylor posts cryptic messages like "tame your ear," clearly trying to maintain conviction among his Bitcoin base. But the underlying infrastructure, the AI sector that often leads crypto sentiment, is showing unsettled economics, as Wang's struggles suggest. If the fundamental underpinning of technological innovation itself is facing economic uncertainty, it adds a layer of caution to the risk on crypto trade. What connects the dots for tomorrow? The bond market is the key. The fact that the 10-year yield is stubbornly holding above 4.1% means pressure remains on long-duration assets. Any major announcement that suggests inflation is not cooling, or any Fed chatter suggesting they remain on high alert, will see the 10-year move higher, which will invariably drag the tech-heavy QQQ lower. The divergence between the large-cap stability, MSFT, AMZN up, and small-cap weakness, IWM down 0.74%, is a crucial tension point. If small caps continue to bleed out while the VIX creeps higher, it signals that the market's foundational risk appetite is deteriorating, even if the top 10 names are holding the indices steady through rotation. We also have global political movement impacting investor sentiment. The news of Ursula von der Leyen pushing for Ukraine's EU accession, despite Russian interference, keeps geopolitical tension near the surface, which ultimately feeds into energy prices and general risk aversion, supporting the narrative that a full-blown risk-off trade remains priced below the surface. Today was a day of holding pattern. The equity market is trapped between fears of stubborn inflation, evidenced by the rising treasury yield, and the lingering promise of AI-driven growth, championed by the behemoths like Amazon and Microsoft. The market isn't selling off because the employment picture remains relatively strong, 4.6% forecast, and policymakers aren't ready to blink yet. But it's not rallying because the cost of money is now demonstrably higher, and the political theater, Trump versus Powell, adds an unpredictable layer of systemic risk. We are in the slow boil phase. The action isn't in the headline indices. It's in the fissures, the underperformance of small caps, the slight strength in specific corporate sectors like travel and banking, and the firm stance of the bond market. Watch that 10-year yield. As long as it keeps climbing near 4.13%, the path of least resistance for broad equities is down, regardless of what Jamie Dimon is doing in his meetings or what Bill Ackman thinks about California taxes.